Welcome, and thank you everyone for tuning in to our latest Economic Outlook report with a focus on economic indicators most impacted by COVID-19. This conversation is taking place on Wednesday, May 6, 2020. Leading today's economic update is Prevedere's Chief Economist Andrew Duguay. Andrew, thank you for joining us.
Thank you, Nicole. Today, we are going to talk a little bit about some of the long-term questions we're getting here at Prevedere around stimulus, debts, and deficits. Now, I know deviating from some of the short-term topics might not seem as relevant, but I think context is really important here when we're talking about some unprecedented levels of spending, both from the federal government with the $2 trillion plus in stimulus money, as well as what we're doing from a monetary policy standpoint. And so many people might be wondering, does this get us out of the recession sooner rather than later? Does this have implications for the next few years as we're planning out? Or does this essentially kick the can down the road to a future point where some of these deficits might impact the economy in a much more drastic way? So we'll talk through some of that as we go along here. First, I wanted to highlight that this is still first and foremost a health crisis here in the United States and around the world. And we know that the side effects of this health crisis are the shelter in place and naturally an economic crisis. And that's why we here in Prevedere, as purveyors of data and analysis about all the economic data that is coming out, we are here to talk about the economic ramifications of this, but it's still largely tied to the coronavirus or the COVID-19. And so I like to start off this presentation by looking at an updated look at the number of daily confirmed new COVID-19 cases, because this gives us an idea of whether we are essentially bending the curve and reducing the rate of increase in cases, as well as the number of new cases. And as you can see here, that we have possibly reached a plateau, right? The data is a little bit noisy, but we are several days away from the peak number of new cases. However, when we look at either the world figures or even here in the United States, we don't have to look very far back to see that where we are today in terms of the number of new cases is still at a very elevated level, particularly to where we were a couple months ago. Now, I bring this up because most of the news right now is focused on reopening, right? That businesses forced to shut down because of the coronavirus are going to start reopening. So for many, this signals and triggers the start of what we can call economic recovery. And you're going to see a lot of data start to show that, hey, everything slowed down virtually to a halt during the time of shutdown, and as businesses start to open up, you'll start to see traffic start to increase, more economic activity going on. However, we are just at the beginning. Part of bending the curve is the admission that you're on the curve, right? And that the number of new cases is still at an elevated level and is going to take a while to curtail. This is going to be something that impacts our world, our economy, and we believe through many more months and quarters out into 2021. And so as we look at the health-related data for some context, we realize that reopening the business is really only the beginning, and that yes, that is going to be a step in the right direction, and that'll mean more people who were previously temporarily unemployed can start working again and contributing to the economy. However, social distancing is still going to be strongly encouraged with the number of new cases still at these elevated levels. And we are going to presumably see that consumers are going to still have drastically changed the way that they act. With some of the early data we're looking at from China, we still see that most spending across most categories is still well below pre-COVID levels. And this is for an economy that was previously growing at a very fast pace, that had contained the virus relatively short order compared to the United States and many other countries, and is not reporting very many new cases. And so what we're seeing is that the post-COVID world, even after the number of cases is reduced to virtually zero, it's still a very conservative economic environment. And consumers are not going to spend the same way that they spent pre-COVID. And so for the United States, we still have a long road ahead of us and our consumers. So when we talk about diagnosing our economic projections that we've talked about in previous webinars, I would say this still very much solidifies from our economist team that we are not looking at a V-shaped recovery, that we still have hopes of a U-shaped recovery, obviously with conditions still tied to the outcome of COVID-19 and how well we can contain it, but this will not be a quick recovery. Now, I don't want to be just a bearer of bad news. I think there is a lot of opportunity, and what we are seeing is that people are finding ways to help each other out, support small businesses. We are also seeing unprecedented levels of support from our government during these times in terms of increased unemployment payouts and stimulus packages designed to help large businesses and small businesses, and then the Federal Reserve also backing that up with very aggressive monetary policy to back up not only what Washington, D.C. is funding, but also to support the financial markets to make sure that there's enough liquidity for businesses who need to borrow. So the outcome of this doesn't have to be bad, it's just going to take a while for the recovery to happen. So on that note of the recovery happening and our federal government helping in terms of unprecedented stimulus, this comes to our next topic. And this just brings up a couple things I wanted to point out in our analysis. One of the charts that I thought was the most significant out of many things we see is this one right here. This is a long-term historic view of the US budget deficit as a percent of GDP compared to the unemployment rate. Now, what we see here is that historically, these have a very tight relationship, that as unemployment falls and the economy grows stronger, what we see is that the deficit as a percent of GDP also tends to fall. And then subsequently, when the economy starts to slow, you tend to see budget deficits rise. Now, these cycles have happened over many different recessions, over many different decades. But one thing is consistent is that the deficits tend to fall when unemployment rates fall. Now, the interesting thing here is that for the first time really in modern history, we saw a very strong deviation from this trend. It's really started in 2016. And we saw unemployment rates continue to fall, the economy continue to grow, but our deficits did not decline. And we started to see our deficit as percent of GDP start to increase year after year after year, all the way up until where we are today. Now, I don't think this is very important on its own, but it does set the context for what I believe is a very interesting fact. It's the fact that every business cycle, we're really setting ourselves up for the next cycle. That governments largely can't take the business cycle away in the long run, but they can either dampen or deepen the downturn. And I think what we're seeing here is a great example of government dampening the downturn from COVID-19 because of the unprecedented levels of stimulus. However, our ability to dampen future downturns and bolster the upturns depends on policy during the good times of economic growth as well. And this is where we look through recent history of the last 4 or 5 years to see that maybe we weren't as fiscally prudent as we should have been ahead of this downturn. Now, the Keynesian policy playbook that we have been playing against for many years is that we do spend during downturns in order to support the economy. And I would think most of us would largely agree that that is a good thing, right? That we are supporting the economy in this vulnerable time rather than becoming more conservative. However, our ability to continue to do that depends on that blue line declining during the good economic times. So this is setting us up with a very interesting situation as we go through this year and we see the trillions of dollars being spent. What does this leave us like with an environment in 2021 or 2022 after this recession is over and we resume back to our normal trends and we expect unemployment rates to go down? Well, these are the projections for the deficit and unemployment in 2020. Now you can see from the orange line that the unemployment rate, and I took the poll from the National Association of Business Economists, the median projection for unemployment at the end of 2020 was around 9.5%. This puts us pretty much in line with the last recession, maybe a slight bit lower. And those projections could obviously change. There's a lot of temporary unemployment right now, but we think by the end of the year that the unemployment rate will largely be around 10%. However, our deficit is not going to be where it was in the last recession. It's actually projected to balloon to around 18% of GDP. This means that we're going to be left with unemployment rates similar to last recession, but debts and deficits that are really more in line with numbers that we didn't see until we go all the way back to World War II, when we had massive increases in debts and deficits in order to fund the war and start to fund and we had to pay that off in the subsequent decades afterwards. This is what I'm talking about when I'm talking about setting ourselves up for the next downturn. If our starting point this time is around 18%, how much more do we have to reduce that in order to get back in line with those historic trends, in order to be well prepared to help during the next economic downturn? I think maybe the good news for those really thinking about the next 6 months or 12 months or even 24 months is that the rooster doesn't have to come calling necessarily very soon. Deficits are not overtly damaging in the near term. So this is a benefit for a lot of developed countries such as the United States, and we can look at Europe and Japan, is that you can actually run large deficits for long periods of time and have very minimal overt consequences to that. If your debts and deficits are backed up by a strong currency, by a government that pays its bills, and an economy that can show some economic growth, then what you have is that deficits can grow for many years without turning into inflation. I think that's the large misnomer here, is that deficits automatically turn into inflation. The fact that you could say the Federal Reserve is essentially printing money in order to stimulate the economy, I'm not arguing for that. I think you can read enough of that out in newspapers and the talking heads about the fact that deficit spending could spur ridiculous amounts of inflation. I think what we've learned from modern economic history is that that's not necessarily true, right? You can look no further than Japan to see an example of a country that can rack up huge deficits and not necessarily have high levels of inflation. So viewing inflation as a little bit of an externality here, I think the interesting tie-in is that deficits are relatively benign until you face inflation. Now, inflation can come from many different angles, but just assume that inflation does come, that's when deficits become a real problem, because you have to roll over your debt. You have to fund it not with 1 or 2% US Treasury rates, right, but a higher level that can be very expensive in rolling over the debts and seeing higher elevated rates of interest payments. This inflation will basically force governments to make a few different decisions. All of these look ugly. None of them are really good outcomes for an economy, but you have to deal with inflation when you have high deficits by one of three ways. Either you can start raising taxes, which will reduce that deficit. You can cut spending, which will also reduce the deficit explicitly, or you could suppress interest rates to be below inflation rates, which is basically a backdoor way of taxing savers, because anything that they're saving is basically getting inflated out, and the government is benefiting by having lower rates of borrowing costs than from their interest rates than what inflation rates are. What you'll see is that if you look back to the last time we had debts and deficits like this, which was post-World War II, we had a number of different approaches, both in the United States and around the world, of a combination of very high taxes, of very conservative spending levels, and monetary and fiscal policies that basically suppressed interest rates below inflation rates. So we saw pretty much an approach of all three. Now, I think we haven't experienced really over the last 10, 20 years any one of these three. We've increased our spending, we have lowered taxes in many different ways, and we've seen an environment where interest rates are low, but inflation rates are even lower in the United States, and that has been a boon to the economy. The interesting thing as we come out of this is, will we be able to sustain all three in order to see a new cycle of economic growth? What we may see, and this is where we get to be an economist and say the future is very uncertain here, but what we may see is that the United States might not pay for this action until the next downturn, when we are in a situation where we are starting from such a high level that we don't have the ability to stimulate our way out of the next downturn like we have with this downturn, and that might cause the next downturn to be more severe. Now, whether that's 5 or 10 years, right? That's not what we're talking about here today. But I think what we should take away from this is that these debts and deficits really are something that gets brought up during downturns, and people like to talk about it because that's where the headline spending comes, right? We've seen the Fed's balance sheet increase from about 1 trillion to 2 trillion during the financial crisis, but now it's going up by about 4 or 5 trillion, its balance sheet during this crisis. And so that makes headline news, and we get a lot of questions about what this means for the economy. And so this is our way of hopefully providing some context to what we see happening. It doesn't necessarily mean that in the short term, a negative thing, right? In fact, it's a positive thing because we're bolstering an economy that's very vulnerable, and this would be a typical approach during a downturn, is to stimulate the economy. I think what we need to consider is that it's really just important during the downturn is during the upturn. How do we as a country face the upturn and say, how do we slowly chip away at some of these gaps that we've seen between the debt to GDP ratio and economic growth in order to set ourselves up for the next economic downturn, so we can support ourselves through monetary policy and fiscal policy. So in closing, I will turn it back over to Nicole.
Thank you, Andrew. Informative presentation and a lot to think about in regards to debts and deficit, economic potential future scenarios. So that concludes this economic update for Wednesday, May 6, 2020. Our thoughts are with all of you and your families, as well as the many scientists and healthcare providers working through the health crisis. Stay tuned for follow-up presentations. And if you have any questions for Andrew, please feel free to contact us. Thank you and bye-bye.